R.C.Brown, lead manager of the MFM UK Primary Opportunities Fund, is with us today to discuss the day after tomorrow. Oliver, good morning.
Good morning, Mary.
So that our audience might better understand our process, can you briefly explain why our approach is predominantly in the primary markets?
So we like to invest at the stage, typically that a company is looking to raise money. The reason we do that is because a company, if it wants to issue new shares, it has to bear its books so that we and other prospective investors can do due diligence on the company. So we can be as confident as we possibly can be that the company is in the condition it says it's in, and that it reduces the chance of nasty surprises further down the line. We also are typically buying in at a discount to the prevailing market price, because if a company wants to issue new shares, it will typically do so at a discount to the prevailing market price. So we are buying into companies that we like, we think are good companies, and we want to hold them, but also we're buying in a bit cheaper than the average investor. Now that discount that we buy in at varies. It may be 2, 3, 4%. It can be 7, 8, 9. It can even be double-digit percentages. And that discount adds additional alpha for our investors. And that's really important because we do that time and time and time again. And we're doing it with companies that we think are good quality companies in the first place as well. So whilst it's very much our bread and butter to buy into companies at the stage that they're raising money, that is most typically already listed companies that are raising fresh capital. It's also the IPO market as well. So companies that are coming to the market for the first time, they also will normally be raising money in order to expand.
Oliver, our process buys listed UK corporates typically when they're expanding their businesses. Why is this important?
So we're buying in at the stage typically where a company is raising money for expansion purposes. So we get the opportunity to speak with the company. We'll speak with the analyst involved as well at the investment bank. And we can build a picture as to what the company plans to do with that money. And we can obviously make our own judgment call as to whether we think they're going to do something sensible with the money. So we start to build up a picture of the management over time. And for companies, it's pretty common for us to have a holding in a company and it wants to raise some more money. So again, as long as it's raising that money for the same sort of reasons that look sensible and strategically correct to us, then we will again look to increase our investment further. So a company that we recently bought into that IPO'd in late 2020, it's a company called HiQ, which designs microbial coverings for fabrics. It's got a blue chip list of customers, some quite well-known names such as Speedo and North Face and Burberry, and they design the coverings that go on fabrics that help stop the transmission of viruses, including COVID-19. So this company is growing very, very quickly, and obviously as a result of the pandemic, its technology has become more into focus, and it's raised money in order to help it accelerate its plans. Now, we've bought into it in the first place, but it's quite possible that in future months and years to come, that this company will actually look to raise further money from investors as well. As it continues expansion, it may find some acquisition targets as well that it wants to buy as well.
It's an understatement to say the least that this has been a difficult time for markets. In terms of the pandemic, what impact has this had on the opportunities made available via the primary markets?
We saw two quite distinctive forms of money being raised as a result of the pandemic. The first was companies that had been materially affected by the pandemic, the likes of leisure companies, airline companies, high street retail companies, whose businesses have been materially impacted. In many cases, had shut down for a period. And they wanted to raise money in order to shore up their balance sheets, knowing full well that further lockdowns could come. Also, with the potential that as the pandemic passed, they would have enough capital to actually be able to expand their businesses into the upswing that was likely to come, and actually, take market share. So we saw companies like Hollywood Bowl, which is the largest 10-pin bowling operator in the country, the Gym Group, a low-cost gym operator, WH Smith, which obviously has its high street retail stores, but also has a real growing presence globally in the airline and railway business outlets. Now, these are all very good quality companies that are market leaders, and we weren't concerned that they weren't going to, trade well one day. But by raising money early, they were taking any liquidity concerns about the balance sheet away from the debate. And as the pandemic passes, we should see these companies, bounce back into the recovery. And because they're market leaders, they should increase their market share. The other distinctive area that we saw in terms of money being raised was actually companies that were trading perfectly well through the pandemic. Now, many of these companies perhaps had exposure to online, or were service companies that just were not, badly affected by the pandemic, particularly once they'd got their heads around the fact that, they were going to have staff working remotely. And we've seen companies that actually want to accelerate their businesses and grow their business as a result of the pandemic. There have been some quite sort of most COVID-specific stocks and fundraisers. A company called Open Orphan, which is used by global manufacturers, vaccine manufacturers, and it tests those vaccines. And obviously that's a real growth area at the moment. We've also seen Source Bio International and Abington Health, which are both produce COVID tests. So they've both raised money as well, because they've seen an opportunity to expand their businesses, in the short term, and use that cash going forward as well to expand other parts of their business. I'm keeping a list of companies that are rumoured to be IPOing, have said they're IPOing, a few companies that are looking to raise money. I've got 13 companies on the IPO list, and then we're in week 2 of January.
How many IPOs do we see in a normal year?
We might invest in 10 to 12. It just feels like there's a sort of a tsunami coming. The difficulty is going to be just pick, because I think we've got a great portfolio now. There's a couple of things I think I could live with selling, but a lot of the other things there's a catalyst I'm waiting for or whatever. So,
Oliver, thank you.
Thank you, Mary.